And welcome to the live. Jessica, how are you? Welcome to the live. Welcome. So, couple things. Welcome. This is my second one back. I think we'll see how Thursday goes. I may just drop it to just Tuesday nights. We'll see how it goes because Tuesday was pretty light, so I don't want to kind of cannibalize the lives and all that. So I may drop to just one a week. We'll see. Let's see how Thursday goes. Everyone, I am so happy to see you on here. Let's start with a couple of things. One, please, if you're looking for materials to buy, either go on my link and buy STC or buy the Achievable one. For SIE, Achievable is off the hook and it's cheap. It's like under $70. I think for the 7, it's in the low hundreds, which is still cheaper than the other ones. STC is solid. You get a discount if you use my link. I love it. I also have the membership stuff. Sandy's doing it, and I think I have one other person doing it, maybe another person. I thought they jumped in. I've done 2 option videos on there already, and I'm about to do spreads and straddles on that. That should be out there this week. And let's go. Any tricks on how to divide a debit versus a credit spread? Okay, so a trick on how to identify a debit spread versus a credit spread. So a spread is always a buy a call, sell a call, or a buy a put, sell a put. It's always buy one, sell the other. It is always that, okay? So the way you tell is that if they're going to give you you find the higher premium. So if you see one with the higher premium, look to see if that's a buy or a sell, because debit means buy, credit means sell. Debit means buy, credit means sell, okay? So if you see that the one with the larger premium is a buy, then it's a debit spread. If you see the larger premium is a sell, then it's a credit spread. That's the best way to do that, okay? It's the other way to do it is if they don't give you premiums, look for the better option. So look for the lower strike call, that's the dominant one. And if that's a buy, it's a debit. If that's a sell, it's a credit. Or if it's a put, look for the higher strike put. If that's a buy, it's a debit. If it's a sell, it's a credit. So remember, buy means debit. So if you go to the store and you buy a pair of shoes, they're debiting your account. If you then bring it back and sell it back to the store because they're the wrong size or whatever, they're selling it back. That's a credit. They're crediting your account. Guys, if you like what I'm doing, hit like, subscribe, and share this shit. I would love to see like 80 people on here where I have total chaos where I can't even keep up. I'd be on here for hours. I love that. Okay. Armana, how are you? Desi, how are you? Okay. So Kate, taking my 66 Friday, have been scoring the high 80s. And it's good. Okay. Awesome. I'm happy to help. But Kate, I think you're in good shape. Okay. You're in good shape with the 80s. Make sure that it's not from memorizing. So yeah, I think that works. Hopefully my videos are helping. If you don't care about money, maybe go to Brian Lee or buy his videos and stuff. But if you're in the 80s and it's because you're knowing the stuff, you're gonna rock this thing. The biggest thing I can tell you is take your fucking time. When you answer questions, make sure you look. Make sure you read the questions, okay? Make sure you read all 4 choices before you're choosing, because even though I've taken it 2 or 3 times, passed all the times, but the first time I took it, I got like an 81, and I was like shocked. I thought I knew it. Then I realized I took it in like 40 minutes, way too fucking fast. So what happens, I realized by going fast, I actually missed some easy ones. So then I let it expire, and I took it again 2 years later, a little over 2 years later, right before they split the SIE and all that. And I got one wrong because I gave scores in. Then I took my entire time and I got one wrong because I took my time. Okay, so I can't stress that enough, that with the 66, even you're always going to feel like you're doing better than you are sometimes. Just take your time and make sure you look for the best answer. It's not always the right answer. Sometimes it's just the best answer. You may not find the right one. You have to find the one that looks the best. Hope that helps, Kate. Ginger, how are you? Welcome on. Okay. Zach, that is awesome. I'm so happy. That is such a big deal. Getting past the first one is like breaking the seal, right? So you get past the first one, and then we get the 7 or the 6, and then we get the 60 test out of the way. It is rock solid. The SIE is not as easy as some people try to say it is. People you work with will say, oh, it's an easy test. It's not easy, okay? It is a struggle if you can't just mail it in, okay? Awesome, Zach. I'm so happy for you. Now, what's the next test? Jen, how are you? Sandy, how are you? Wendy, how are you? Okay. Okay, so let me catch up. Okay. Okay. What's it? Okay, so what's in Hago? Is that not supposed to be there? Okay. So let's talk about safest. Okay. So on the Muni world, okay. Dexter, awesome. I love it. Dexter, welcome. I love it. Same for me. Spend a Tuesday night with you guys. Okay. So now I do them on Thursdays too, but it's really light sometimes. So that's why I think I'm going to drop the Thursdays. We'll see. Okay. So can I rank these from safest and talk about a little bit? Okay. So let's start. I'm gonna expand on this a little bit because they're not always this safe. So the safest of them all is what they call escrow to maturity, or escrow to maturity. They call it pre-refunded, advance refunded bonds. Those are bonds. They're not issued that way, but they're bonds that where the issuer will buy treasuries to help pay them off, and those things are backed by the government, so they're safe. Then I would say, and again, none of this can really work, but I'd say the next safest one is probably double barrel. Or how about this way? An insured bond would be the next one, okay? An insured bond, which means there's insurance. If they don't pay the interest and principal, they'll pay it. The next one up is a double barrel, where it's a double barrel is a revenue bond. Okay, it's a revenue bond that, like, say it's a hospital and they don't have enough money coming in. Say they all sudden, say with the pandemic, all these hospitals were losing money. So what happens is they go, okay, when they were issued as a double barrel bond, if they don't have enough money to pay the debt service, what they do is they go and they take money from ad valorem, which is written into the contract, which also means double barrels have to be voted on because the local towns are taking on the liability of the town. I'm going to lower this to see something bright for me. We need, the darker it is, the better. Like I say, I was really good looking before electricity. Candlelight, I'm awesome. Okay, so now, actually, it looks even worse. Let's screw with this a little bit because you guys love to just see me do nothing without helping you guys. Okay, hold on. Look at all the different colors. Ooh, I'm very pale. Ooh, not so pale. There it is. Okay, pretend to have color. Okay, so then the next one up will be probably moral obligation, where a moral obligation is, it's like a stadium where I issue a revenue bond, and if like for a stadium or something like that, and if I don't have enough money to pay my debt service, I ask the town to pay, and they just get to vote on it in like a legislative session, a budget session. They go, look, we're gonna help Ken or not, and they can say no or yes. So it's a moral obligation. They don't have to. Okay. Oh, Andy, that's all. Let me get back to you, Jen. Andy, that's awesome. I didn't even read that. Boom, you're done. I can't believe it. Andy, that is awesome. There's nothing better than being done with all these exams. I have so many people that I talk to that they're just done before they even take it. I feel so horrible. That is such a process. I really feel bad, and that's why I'm trying to do these things, is that I feel so bad because everyone's struggling, and you didn't. You nailed it. I love it, Andy. That is awesome. It's nothing. What the next part of this is, for the next week or so, maybe another week or so, you're still going to wake up in a panic. Oh, wait, I have to study. Oh, I don't. It's going to be a great feeling. It's kind of like waking up on a Saturday morning and realizing there's no school or work. You go back to sleep. That's awesome, Andy. Congratulations. Okay. Back to this. So then industrial development bonds, again, you can't really rank these that much because it's based on their credit rating. But the next one is industrial development bonds. Those are bonds where, like, a town will issue a bond to open up a property, like, maybe the Jacob Javits Center. Maybe New York City buys a property, borrows the money, borrows the money in an industrial revenue bond, and builds the Jacob Javits Center. And whoever owns the Jacob Javits Center, I don't know who it is, it could be the city, really. But as I say, it's a corporation that owns it. So the city is doing this to make money. They will put up like a strip mall or a mall or a convention center, and someone will rent it from them. That rent is what's paying the interest. So the credit rating is based on the corporation. So let's do, by me, we have the Short Hills Mall. It's a really big mall. Short Hills opened up a mall like maybe 20 years ago, maybe more, maybe 30 years ago. But it's a really high-end mall. So the town built it in a way, and then they leased it out to, say, Simon's Mall. They're renting that property from them. So built into the indenture, it'll say, here's a $20 billion bond. The Simon's Mall will be paying us $1 million a month for it, whatever it is. And could be more than that, probably is more than that. But the credit rating is based on Simon's Mall, not the town of Short Hills. So that's a riskier one. Hope that helps. And then regular revenues, then it's based on credit rating and stuff like that. Hope that helped, Jen. Okay. Okay, okay. Boom, I'll get to you. Hold on. Okay. Okay. So Pepsi, retail and institution are their own thing. Accredited is a different thing. Okay. So retail is like human beings. Okay. Regular people that, maybe if you have $50 million, they'll say you're an institution. But for the most part, retail is like normal human beings. And they cannot buy a lot. They can't do, if you sell to a retail person, you have to be registered in the state, and so does the security, unless there's exemptions, like if the retail calls you. An institution is whatever the state says it is, like a bank, a broker-dealer, a mutual fund, an investment advisor, any firm that manages money and stuff like that. So that's an institutional investor, okay? An accredited investor, that has nothing to do with it. It could be a human being or a firm. An accredited investor, remember, is 1, 2, 3 accredited, or if you have the 7 or 65. So an accredited investor, they either have a net worth of 1 million, or they make 200 grand if they're happy, single, or they make 300 grand a year if they're miserable, married. 1, 2, 3 accredited, 1 million, 200, 300 accredited. Hope that helps. They're not the same. So institutional versus retail is one bucket. Accredited is another. Okay, Chad. Where are your scores falling? Where they say, oh, Zach, awesome, going for the 7. Navigation video, take the SIE first. That's the only one you can take before you do anything. Navigation video, go take the SIE. You can sign up for yourself. If you take the 7 or the 6, you have to be sponsored by a firm. Then you can take the 60 exam. So if you know everything I'm talking about, go take the SIE exam. Back to this. So Chad, you keep getting 60, 62. So where are you getting hurt? Is it the rules and regs? Is it the present value stuff? Whose books you're using? So there's a lot of things to it. A 62 means you're missing it by 5, maybe 10 questions, right? So we have to figure out where you're missing the questions by. And that's where we have to figure this out. So it could be regs, which is the broker-dealer, investment advisor stuff. It could be present value, future value. It could be the investment vehicles. Where are they saying you're getting hurt the most? And the other thing you could do, Chad, so not kill yourself, why don't you go take the 63 and then take the 65 separately? Because it covers the same stuff. And if your firm won't do it, just do it yourself. Because the SIE, the 63, 65, 66, you can do without sponsoring. If you're having a tough time with the 66, I have a couple of students that couldn't pass the 66. So we switched them to taking the 63 and 65, and they nailed it. Give that a shot. That may work, and that may help you. Because at least that if you get the 63, you get some confidence. You got half the exam out, the regs, and then maybe, and even if you miss it, you can take the 65 and then take the 63 again. Okay. Zach, awesome. Okay. No, Jessica, it's not important to understand reallowance. Okay. Tyler, no problem. I'm happy to help you. You know that I don't like AD Banker, but for the SIE, and you could probably get past the 6 with it. Maybe even the 63, but which is, I'm sure, what you're taking next, right? So after the 63, you're done. Yeah, the 63 stuff is just dry, right? The books, it's all about regs and, about what a broker-dealer is, where they register, some of the administrative stuff, ethics and stuff like that. So just, keep reading. The thing is, the 63, I'm a big fan of taking tests. I'm really a big fan of taking quizzes with the 63 to get your timing down, okay? It's really a lot about getting your timing down, so this way you're not rushed. Because one of the bigger issues on the 63 is they just run out of time, okay? So I hope that helps, Okay, Kate, time weighted and dollar weighted. Okay, I can do that, okay. Thanks, Tyler. I'm glad I'm better than, and then I'll work in ADV part 1 and 2, okay. So again, Jen, Desi, I've done that a couple of times. There's only like 4 to 5 different order types. Look on my last one. I think I've covered it. Judy, welcome on. I love it. Okay. How many hours behind? I'm way behind. I'm 5 minutes behind. Okay, not bad. Okay. Where are we? We're talking about it. Okay. Time weighted and dollar weighted. Okay. So the one thing is, we know what you need to remember mostly about time weighted is, time weighted is how we compare managers. Dollar weighted is how we look at our own portfolio. So time weighted ignores the fact that investors will invest and withdraw, which will affect, like if I'm a manager and I'm managing and doing your portfolio, the fact that you want to withdraw 10% of your assets or put it in is going to affect my return because they're going to sell and buy, and maybe that's at the wrong time. So dollar weighted takes into account the money you're putting in and out, right? So that's a problem, okay? So if you're doing your own portfolio, yeah, that works. That's how you can figure out your own portfolio. But if you're trying to compare managers, it's not fair to do dollar weighted, because what if like manager A has clients who just buy and hold and they're fine, and manager B has guys who buy in and out all the time. So what happens is then they may have to sell when they don't want to, and it's going to hurt their return. So time weighted doesn't count, ignores cash flows in and out. So that's better to compare managers. And dollar weighted is better. It counts cash flow in and out. So that would be better for you, for checking out your own portfolio. Okay. Okay, ADV part 1 and 2. Okay, so ADV part 1 is how an advisor registers. That's the facts, branch, names of the owners, how much money we have, what kind of customers we have, what we're doing, not the disclosure stuff, but the little stuff. Okay. Now, that's part 1. That's the facts. That doesn't have to be given to the customers. Part 2 is disclosures. It's like how we manage the money. Do we charge different fees to different people? Any kind of conflicts we have, any control relations we have. And part 2A is about the firm. Can we charge different people different fees? Yes, as long as we disclose it on the Form ADV part 2. So 2A is about the firm. So let's say you work for Morgan Stanley. So part 2A would be about Morgan Stanley, how they manage the fees, what they do, all that stuff. Part 2B is about your team. So say you're with a team or yourself. Part 2B will have your bio, your history, how you manage the money, maybe your track record, if they can, stuff like that. Any conflicts or control relationships you have. And it's really, another word for part 2 is called the disclosure document or the brochure. Okay, part 2A and 2B is a disclosure document or the brochure. They may even call 2B the brochure supplement. The brochure or the disclosure doc has to be given to the customer at or prior to signing the contract. They call it federal law. Under state law, they have to give it to them 48 hours at a time. And if they don't give it to them 48 hours at a time, they get 5 days to back out of it. That's state, not federal. Federal is at or prior. And you should try to get one signed, to get it signed that they received it. One more thing on this. If you are a solicitor, you're going to have your own ADV part 2 if you're registered as an IA under the state, because the SEC doesn't give a shit. So you will have your own ADV part 2, and you have to, when you're a solicitor who's finding clients for an investment advisor, you have to give them your brochure and the investment advisor's brochure, and try to keep a record of them getting it, and keep that for how many years? 5 years. Good. Okay. Okay. There you go. Pink gorillas drink martinis. What is that? I don't know that one. Okay, but I'd love to see a pink gorilla drink martinis. So now, order type. So so remember slobs over bits. Sell limits and buy stops are placed above. Buy limits and sell stops are placed below. Buy limits and sell stops are more for taking profits or creating positions. Stops protect, right? So if you own stock at 50 and you want to sell it when it gets up, you would do a sell limit. Or if you want to sell it when it gets, like say you own stock at 50, it's going to go down, you're afraid it's going to go down to like 45, you would do a sell stop. So once a stock got down to 45, you would sell it. Okay. So if you're long stock, let's talk about what you can do. If you're long stock, you sell a call for income, you have a sell limit for taking profits. You buy a put for protection, and you do a sell stop for protection. If you're short stock, you would sell a put for income, you would buy a call for protection, you would do a buy stop for protection also, and you do a buy limit for taking a profit. I hope that helps a little bit. Okay. And remember, slobs over bits. Sell limits and buy stops are above the market price. Buy limits and sell stops are placed below. And bliss orders, the ones below, will be adjusted on the X day for stock splits and stock and dividends. Okay. Okay. Shh. Hope that helps, Tyler, with the ADV. Okay. Okay. Secondary distribution. Oh, pre-sale. Oh, those type of orders. Okay. Right. So that's your order priority, right? Okay. Pre-sale group designated member. So, okay. Pretty girls drive Mercedes, whatever works. So what Armand is talking about is pre-sale group designated member. That's when I'll get to your secondary stuff. So when you're a muni and you're getting orders from your customers, which ones get priority? Which ones get filled first? So pre-sale orders are orders you receive before you've even been announced as a syndicate member. So I'm bidding on an issue to do, as I said, the New York City's going to do a geo bond. I'm bidding on it. They haven't chosen which one it is. Any orders I get during that period, they're called pre-sale orders. They get first priority. Then any order I receive from a customer after I've been announced as the winning syndicate are called group orders, okay? Any order where they designate that I only want a certain member of the syndicate to receive the cash, that's designated. And anything where a member of the syndicate wants to buy the bond for their own investment is called member. They come last because customers have to come first. PGDM, Pink Gorillas drink martinis. I say pretty girls drive Mercedes, pro golfers don't miss, stuff like that. Okay. As my friend said when he went into the test, he goes, please God deliver me. There you go. Okay. So now, can I go over secondary distributions? Yes. So let's talk about this for a second. So when a company issues shares for the first time, that's called an IPO. If they issue shares the second, third, fourth, fifth time, like adding more, that's called an additional or a follow-on. Guys, if you like what I'm doing, hit the like shit, okay? So now, or at least share this stuff. Tell people about it. Even if I don't like it, just share it. Tell the people you work with, even if it's embarrassing, be a shill. Please help me out. I'm almost at 3,500. I want 10,000. I want 10,000 fast. I want 10,000. Okay. Getting there. It's picking up speed. I'm adding about 250 a month. So now, so an IPO is first time issuance. Anything after that is a additional offering when the company issues it. A secondary distribution is when somebody who is an owner, like Bill Gates or Steve Jobs, Richard Branson, Elon Musk, somebody who's like a control person or a big owner wants to sell their shares. And if they're too big and they normally have to do 144, which I did the video on, but if they don't want to do it through an offering, they have to go to secondary where they can do the whole thing. You get a prospectus and all that shit. So primary offering means the company's receiving the money. That can be an IPO or an additional or follow-on, which means they issue more shares. A secondary means some sort of shareholders getting the money, which is done in a secondary offering. They can do a split or a combined offering where, say, Microsoft is issuing a bunch of shares. Bill Gates goes, I got to pay for my divorce. I'm going to add some shares onto that and sell them out of my own account. So a secondary distribution means that the issuer is not getting the money. One of the shareholders is. A primary distribution is either IPO or additional, and it means the company's getting the money. Those shares would dilute you. Good. Okay. Okay, Sean. Good. Okay. Okay. Yeah, I'm not a fan for AD Banker on anything. I'm not a fan for an AD Banker on anything, but you can, and look, and I got my butt handed to me on someone who said, I use AD Banker and I passed them all, but yeah, they're the lucky one. Okay. But I'm telling you, if you have a choice for the 7, I would go with Achievable. I would go with SEC, Kappa, Notman. That's perfect. Any training consultants is a good supplement. Okay. Now, exchange traded notes. ETNs are debt, right? So you're lending a company money, and what they're doing is they're not paying you till the end. They're paying at the end, which you got. Okay. Their return is going to be based on how the stocks they're tracking. Like I have the FANG ones, right? The Facebook, Amazon, Netflix, Google. I have 3 times leverage ones and I have regular ones. So I don't get anything. So I buy them for $50, say, and then at the end of 20 or 30 years, I'm going to get back my 50 plus or minus whatever those stocks or index they're tracking on. I get nothing out of it, okay, until then. But it trades in the market. I can buy it and sell it. Trades just like an ETF. You can buy it on margin. You can sell it short, trade it intraday, all that stuff. Another thing you have to remember, there's 2 risks with an ETN. 1, market risk, and 2, credit risk. Market risk and credit risk. Those are the 2 big risks because it's debt. You're lending money. So the fact that, one of the ETNs I have is issued by the Bank of Montreal. Their earnings came out. I think their earnings came out lower than expected, so the ETN dropped a little bit. Not a lot, not enough to worry about, but it did drop a little bit because the risk went up. So that's kind of where it is with the ETNs. They have credit risk. ETFs do not have credit risk. As far as the normal retail investor, they trade the same way as ETFs. You would never really know the difference. But ETNs are sophisticated, so only really sophisticated or people who have serious portfolios should be investing in ETNs. Okay. Caleb, I didn't see you. Were you on here? Caleb, how are you? I didn't see you. Okay. Tyler, I hope that helped with the ADV. Okay. Yeah, Sean, 80 banker, I don't like for anything. But if it's for the SIE or the 6, you could probably get away with it. I think the rest of them, it's going to be tough. Maybe the 63, if you really go over the videos and try to really find some extra stuff. Go on Investopedia. It's free. There's some free stuff on there. Okay. Okay. So do they have to keep the bond? They probably do. So normally, anytime a broker-dealer IA terminates, where they stop, they have to keep their records for at least another 3 years, which probably means a surety bond would have to be kept also. Why is that so? Because the statute of limitations is 3 years. So after broker-dealer fails, they can still be sued for okay. Okay. Yes, I'll be on Thursday. I'm not giving it up yet, but I will. Okay. Boom, Pepsi. I love it. Okay. Hey, I day traded every day. I traded, check numbers every day. I never thought you should hold the stock except for a week straight. Just rebuy at the right time. Okay. For day trading, it's fine. You can do that. But that's not, if you're in our business, you can't tell them to day trade. It's not for it's not for most people. Most retail people should not be rebuying. Because look, in reality, yes, you can get lucky. And if you've been doing it for, here's the problem. If you've been day trading since 2009, 2010, you've been during one of the largest, longest bull runs ever in the history, okay? Where the market's been basically straight up since then. It's very easy to day trade, to just buy. So, but the problem is, can you handle the losses, right? So you don't know if it's going to go down, and you don't know, like you think, oh, I'm going to buy it. And then what if you buy it at the wrong time? You think you got a dip, and then it dips more, and then it dips more, and then it dips more. Since 2009, basically, if a stock dropped, you buy it, you're making money because it's going up. When we hit a bear market, which should happen in the next 2 years or so, it's because it's time. It hasn't been one. If you say, oh, I'm going to buy in the dip, it may dip even more and keep going, and you lose your money. But if you buy and hold and forget about it, over the long haul, 10, 15, 20 years, you will average around 10% a year. Even the day traders, most of the day traders have had a good run for 5 or 10 years. They're going to get hammered. Okay. And again, more so for this test, we're not into day trading. It's more for sophisticated investors. Okay. No, so a secondary, they would file, because they have to use a prospectus. So they would file that they're doing it with the SEC. But it's not new. They just have to notify. They have to do a prospectus. Because if you do a secondary, you're doing an offering. So people have to get a prospectus. Okay. Okay. The good thing is, why would you say? I mean, okay. Now, lagging growth, coincident inflation. Okay. So the 3 indicators, okay? The 3 indicators that you have. Am I caught up? Yeah, I'm almost caught up. That's crazy. Okay. Now. Okay. But did you guys do the study group? I hope it worked. Okay. So now, I hope the study groups are working. I hope it's working out. So lagging, leading, and all that stuff. So there are 3 types of economic indicators. Leading, which is telling you where we're going to be in the future. Like, think about this. Everyone was freaking out because the stock market was skyrocketing last fall. It's not because the market was going in and now. They were predicting 6 months to a year in the future. They were predicting now. So the stock market rose all summer and fall because it was predicting what's going to happen now. Vaccines, all that stuff, the market, the economy going well. That's what they were predicting. So the stock market is a leading indicator, okay? It's an indicator of where we are in the future, where we're going to go in the future. Coincident is kind of where we are now. So the biggest leading indicator is the stock market. Coincident is where we are now. That's like length of unemployment, stuff like that. You do not have to know all the different indicators. There's 36 of them. They're not going to make you memorize them. Then lagging is where we were. That's like corporate profits. Corporate profits are reported when? At the end of the year. They're telling us where we were. Okay. So leading, lagging, and coincident. Leading is where we're going. Coincident is where we are. Lagging is where we were. I'm going to try this for a second. So the mute works. Good. Okay. 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 What's inflation? Inflation is measured by CPI. Inflation is when prices of stuff are going up, right? So prices of stuff are going up. We're hit, like last month, we hit 4% inflation because of the wood and the building materials are skyrocketing. I mean, think about it. If you tried to build a house 2 years ago, say a 2x4 would cost you like $5. Now it costs 20. That's insane, but that's inflation. Things go up in price all the time. So what do you do to hedge that? You are going to buy stock. You're going to buy common stock, equities. They're the best hedge against inflation. So then you mentioned growth. There's growth and value stocks, right? So, and by the way, during an expanding economy, we'd have inflation. We want some inflation. We just don't want a lot. Then there's growth versus value stocks. Growth stocks, they should return better than expected. They have low to no dividends, high retained earnings, and a high PE ratio. Value stocks usually pay a dividend, maybe. They're kind of out of favor right now. Like maybe the airlines were value stocks last year. Nobody wanted them. Now they're building up. They usually pay a dividend of some sort, and they have a low PE ratio. It helps. Called the multiple. Okay, I'm going to delete that anyway because why even have it there? Put them in the timeout. Okay. Now, guys, if anyone's doing this Series 63, let me know because I have a guy, Zach, who's looking for someone to study with a little bit on the things. And I do these as he's a member, so I think he does the middle member. So once a week I do a call, and since it's only him, I'll do it on Zoom. But really, for $24 a month, he gets an hour with me for that. So it's just interesting. Okay. Now, oh, that's funny. I don't remember. So I remember primary is when the issuer gets the money. Secondary is when the investor gets the money. Okay. Let me go back to this one. Yeah, navigation. That's great if you're trying for 1% a day, but you are taking a lot of risk, right? So I always said, if I could make 1% a day compounding, I would take a $5,000 and it'd become $500,000, right? It's hard to do. I mean, it works. I mean, maybe it worked since March or whatever, but I mean, because the market's been skyrocketing, but it's high risk, high reward, right? So an average return is 10% a year, which is about, a little over 1% a month. Getting 1% a day is awesome. That's awesome. I'm happy for you. But it's high risk, right? It's high risk. And it's at one point you're going to lose 20%. Half the game is Pepsi should be in there. She's very super knowledgeable on this stuff. I mean, you're taking high risk. So maybe you'll do well, and I hope you do. I hope you never take a hit. But half the game of this day trading stuff is knowing when to sell, not so much when to buy. Okay. How many accrued interests are on the typically accrued interest? Maybe one or two, but it's not big, right? It's maybe they make you do everyone I asked said on the accrued interest that they're not asking the dollar, asking. Well, that's horrible. Good thing they didn't hear that. My daughter would kill me. Normally they're not asking you to come up with how much in accrued interest, more just either how many days or how to calculate it or when you calculate it. So accrued interest, remember, accrued interest is your bond. Remember, bonds pay every 6 months. So if you sell the bond in between those periods, there's interest that you've been accruing that you're not getting. So the person who buys it, the person who buys it, has to pay the seller the interest that the seller was accruing during that time. So you're going to go back to the last payment date. So if you buy, say it's a J&J bond, you're going to buy, say you buy it in May, you're going to go all the way back to January, count up all those days and pay them that much of accrued interest from January till now. The question is, when do you do it in May? So if I buy a bond on Monday, May 10th, corporate bond, it settles on the Wednesday. So it means I pay. Okay. No, here's the thing. That's not my thing. Okay. If you're doing good, you're fine. That's not what I do. I used to do that trading shit, but now I just buy and hold. You're best off if you think you can trade. Go to a place like T3 or something like that, where they'll leverage your money. You go to T3, you take the test, they'll take whatever money you have and leverage it like 10, 15 times. So you can make money and you have support and you get access to Bloomberg and all more information. It's really good. I mean, they're solid stuff. Okay. T3 is the place you should look at, or I forgot the names of the other ones. Okay. 7 points where you trade their money. So again, accrued interest, you're going back to the last one. So if you buy a bond on Monday, it settles on Wednesday. You count up until Tuesday. Okay. You count up until Tuesday, the day before settlement. Okay. Okay. Yeah, the mastery exams are tough. The green lights and masteries are freaking hard, especially Kaplan stuff. They really are. They make you worry. They really, really test you. Okay. So Jessica, again, there's like 2 or 3 accrued interest. Most of it's just about whether you have to, when you count till, so remember, if it's a corporate or muni, it's going to be a 30-day month, 360-day year. And that when you trade, it's T+2. For the treasury, it's an actual day, 31-day month, 30, 28, whatever it is. And it's T+1 because treasuries are T+1. Always remember, it's the day before settlement, no matter what day it is. So if it settles on Monday, you count to Sunday. Like one of the guys I saw talking about it said, oh, they would never give you Christmas because it's offensive. Okay, I could see where you're coming with it, but that's fucking moronic because Christmas is an actual holiday. We are not open for Christmas. So they could say December 26th. You know you're counting accrued interest until the 25th. If it settles on the 26th of December, which is the day after Christmas, you are absolutely counting to the 25th on accrued interest because accrued interest is calendar days, not business days. Settlement is business days. So if you buy a muni bond on Wednesday, say you buy a muni bond on Thursday, it settles on Friday, it settles on Monday, which means it counts as Sunday in accrued interest. Hope that helps, Jessica. Okay. Okay, Wendy, an open-end covenant. So there are 2 types of covenant to bonds, open-end and closed-end. Closed-end means we're going to issue a bond, and then if we issue any more bonds, those bonds are after these bonds in order of payout. So if you buy a bond from my company, hint, hint, hint. Okay, if you buy a bond from my company, you're going to do it based on the income that I earn and what the ratio between what you're borrowing versus what I made. And then any new bond after that is going to be paid after you, which means you got the first bonds issued, it will be the first ones paid. And then once they're paid, anyone else is done. Open end means that any new bonds issued after, this is not what you want. This is not a good thing. This is any bond issued after the first one's issued will have equal standing on the claim on assets, which means so you buy a bond knowing that I'm issuing a certain amount versus my earnings or assets, and you feel good with that ratio. If I sent out, if I do an open end, then any new bonds have equal claim, which means now there's more people sharing in those what you owe in that ratio. So it's not a good thing. Closed end means any new bonds are issued with the lower priority of payment, where they're subordinate to the first ones. Open end means that they're equal. Hope that helps. Okay. Yeah, like navigation, like I said, you can send it to me and you can email it to me through my website and all, and I charge $150 an hour, but I'm not going to help you that much because I don't day trade anymore. I ran day traders, and I think day traders lose money, okay? Okay. You don't have a screen? Am I on? Am I on? It's funny. Watch, it's on, and I'm sure you can see me. Okay. 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 Judy, did you ask a question? Did you text me it? Yours never come through for some reason. Hold on. Because it's too long. So I'm sure you texted it to me, which is good. Okay. I think I did answer one question. Let's see. Did Judy ask me? I know I answered one of your questions. Maybe you weren't paying attention. Let's see. C10, I'm getting better at not saying, okay. I'm just kind of letting it go. Okay. And I just said it. So I read the question about the BD and the surety bond. I hope is that the question you're talking about? So I'm not answering it again. Okay, yes. So yeah, I did answer that. So the BD, everything about a BD, okay? Whenever a broker-dealer or IA shuts down, you have to keep records for 3 years, okay? Now, that also means probably the surety bond has to be kept for 3 years after that, because the statute of limitations is 3 years So after a firm goes under or disappears, they could technically still be sued for another 3 years. Okay, I hope that helps. Does that answer your question? So yes. Okay. Not too bad. This wasn't half bad. Okay. No, they don't have to. They don't hold the shit. They don't hold anything. That's not the question. So you could ask that, but they're not going to ask that. So don't worry about it. STC might or Kaplan might, but they're not doing that. They're going to ask how long, because IAs and IARs, I mean, agents and IARs don't have record keeping requirements. Broker dealers do. IAs do. So they're not going to hold it. Once you're done, you're still subject for a year after, but once you're gone, you're gone. I mean, they can still sue you because they have 3 years. But yeah, you're not going to have to keep a surety bond for 3 years. They don't know. Agents and IARs don't really have that. So we'll go with the firm. Okay. Why would you want to sell a call and buy a put? I know call to buy into. Okay. Okay. So let's say, okay, fair enough. Normally, think about this. When you buy puts and stuff like that, normally it's for if you're owning stock and you want to protect it, right? So if you're a long stock, say you're long stock at 50, you're where it's going to drop. So if you buy a 45 put, even if it goes to 0, you can still sell it at 45. My option videos help with that. Just so you know, you can even go on my website and buy them straight out. Okay, so now, shameless plug by me. Okay, now, and I'm doing these, by the way, I'm doing the spreads and straddles either tonight or tomorrow. So Sandy, it should be out there. It should be in your inbox or whatever by Thursday. I think when I do the membership stuff, the members get notified right away that I did that video. Guys, I hope you guys like my little TikTok videos that I'm doing. I'm doing shorter ones just so that you don't have to spend 20 minutes watching something. You can just watch it. I'm trying to start a trend on my TikTok of a way too fast description where it's not totally everything, but it's like bullet point stuff. Let's see what happens. I'm the king of social media now. That's what I'm doing. Okay. So now, Sean, why would I sell a call? So if you sell a 50 call at 3, that means you have $3 in your pocket from selling the call. I hope we get that. If the stock drops to 45 and it stays there, then the person who bought the call will not exercise and it'll expire and you keep the $3. So when you sell a call, you want the stock to drop so it'll expire and you keep the money. If you buy a put, say you buy a 50 put at 4 and you think this, say GameStop was at 180, you buy a 180 put at 5, say it's a lot more than that. If then GameStop drops to 100, you could just sell the option because it's going to be worth a lot more than you bought it for. But if you want to go through the exercise game, so if you buy a 180 put at 4, GameStop 180 put at 4, you have the right to sell it at 180 anytime you want, as long as it's an open option. If the stock drops to 100, couldn't you buy the stock at 100 and immediately exercise the put and sell the stock at 180 and make $80 minus your premium? So buying a put means you want the stock to go down so you can profit. So you can either buy the stock at a low price and sell it at your strike, or just sell the put for more because it's worth more. As the stock drops, a put will be worth more and more and more. When you sell a call, you have the premium, and the most you can make is that premium. So you're hoping the option expires and you keep the money. Remember, whenever you sell an option, it's for income, but the bigger one is whenever you sell an option, you want it to fucking die. You want it to expire, so you keep the premium. You're getting income. Whenever you buy an option, you kind of want to use it because you spent money, so you want to use something. Okay, hope that helps. Okay. 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 So navigation, let me hit you on this. So here's what happens, okay? Navigation, I'll hit your, any shortcuts for accretion and amortization? Not really. So accretions, I have a video on this. You better freaking watch it. I did a video on this. Watch it. But remember this, okay? Accretion, OID, which is zero coupon, you must accrete. So really, if you buy an OID, which is a zero coupon, you must accrete every year. Now, the secondary market discounts, you don't have to. These are the shortcuts. On the premium side, only munis must amortize. Treasuries and corporates don't have to. So again, the only things that actually have to versus get to. OID, you must accrete, and only muni premiums you must amortize. Boom, everything else is may or may not. Just remember, you're taking the distance from par. So par is 1,000. The amount that you buy it at is say 1,200. That's 200 from par. Or you buy it from 800. That's 200 from par. You divide that number by the number of years to maturity, and that tells you how much you're going to amortize or accrete. So the distance from par divided by the number of years is the amount you amortize or accrete. And remember, if it's amortized, it's a premium. You're going to amortize down to par. If it's accretion, it's a discount. You're going to accrete up. Okay? You're always going toward par. Hope that helps, Jessica. I wasn't really mad. I'm just fucking with you. Okay. Day trading. Here's the problem with day trading is let me just say, I ran a firm. I was a chief compliance officer for a prop trading firm. 250 traders at any time. They had everything, access to Bloomberg, Reuters, all that stuff, everything. The algorithms are faster than you are. I had a couple guys that made money. So out of 250 people, maybe 50 guys made 50 guys, and it wasn't the same 50. It was in any given month, maybe 50 of them would make some money, okay, or not lose money. How about that? Out of that 50, maybe 10 would make it consistent. Out of that 10, maybe 2 would make enough to live on. Okay, and we were leveraging them 10 to 1. If they have 100 grand, we're giving them $1 million in buying power. So day traders, what happens is you get hammered because there's timing risk, and that's the problem. Right now, the market's going up like crazy. It's not always going to do that. So what happens? Say you buy stock at 50, it goes to 60. You sell it say it starts dropping to 58. You sell it. You hope it's going to go down to like 52, and then you buy it. Okay, that's great. You can do that. But what happens when this one? So what happens if you buy it at 50 and then it drops to 48 and you buy more? And then it goes to 44, buys more. Then it goes to 42, you buy more. Then it goes to 30, you buy more. You just lost a ton of money. You're now out of money. The floor is 0. Remember, so it doesn't always go there. But the floor you could talk a 20% loss. So averaging down works if you have enough money. If you have enough money to back it up. If you have millions of dollars, then yeah, you could probably make it work. Okay. But if you have a budget, at some point you run out of money and you just got to ride it out. Like if you buy it at 40 and it goes to 30, and you buy it at 30, it goes to 20, you buy it at 20. Yes, you're averaging down and buying the dips, but there's no reason it has to go back up again. And right now it is because the Fed is pumping money into the markets. Okay. That's kind of why navigation. I'm not saying you can't make money. There are definitely people who make money. Look at Portnoy. He made money, but then at 30 years, he took a bad hit at some point. Okay. Where can a client who is shopping for broker-dealer prices see where broker-dealers charge for markups, markdowns, since they are shown after the fact in the trade confirm and BDs don't have to disclose? You have to call them and ask them. It might be on their website. They might do it on their website. Other than that, you have to ask them. It won't be on the order ticket. So if that's a question, that wouldn't be on the test. But if you're shopping around a broker-dealer, you have to call them and say, what are your commissions? Usually they'll give you a commission schedule. A lot of times they will give you a commission schedule, and then you're in good shape. Okay. So Sophia, before I do that. Okay. Right. So Sophia, I'll get to you in a second. So yes, an administrator can deny non-federally covered securities, right? So if it's really charitable, religious, nonprofit, and it's insurance companies selling in their state. That's kind of it. Everything else they can't deny the exemption on the security. Exempt transactions they can, and your registration they can, but not that. Okay, Jen, don't sweat the balance sheet too much. I'm not saying it's easy, but make sure you go look at know what's on the balance sheet, assets and liabilities. Know what's on the income statement, which is cash flow and stuff like that. You got to know PE ratio. You got to know earnings per share. You have to know that fundamentalists use balance sheets and earnings and income statements, where technical traders use, charts and trends and patterns. I'm working on a short video on that. Okay. Now, Sophia, when are you taking the test? Because I have a whole video called How to Pass the Series 6. It's a whole 45-minute video on. It's about an hour. So it's about 40 minutes on mutual funds and then about 20 minutes on annuities. And I chapter it out so you can just skip right to it. If you're taking the test in the next day or two, I'll do it right now. If not, go watch my How to Pass the Series 6. Whether you're taking that or not, it doesn't matter. It's in my If You Want to Pass the Series 7 playlist. One that has like 6 or 7 questions on it, 6 or 7 videos. Go in there and it's called How to Pass the Series 6 and 7. Go on there, watch that video. You can even skip the mutual fund stuff and go right to the right to that. If that doesn't answer your questions, I'll be on Thursday and we can do it then. I'm just saying because it's a long ass answer right now, and I only have about 10 minutes left, so it's a long ass question. So I can do that, but if you're not taking the test in the next 2 days, go watch my video and then we can tweak it on Thursday. Does that seem fair? Okay. 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 Okay, so you're good. So go watch Sophia. So go watch. That's so you have some time. So go watch my video. Okay. Go watch my How to Pass the Series 6 video. You can find it, and then I don't know if I can do it in here. Can I do that? I don't know. See if I'm good. See if I can make this work. Hey, I can watch my own live if I do this. Okay, that's funny. I can click on it. Really confuse everything. Okay, so now, guys, give me half a second. I'm trying to find something so I can send it. Yeah, I think it's on the thing called If You Want to Pass the Series 6. I mean, it's a video. The suitability is called If You Want to Pass the Series 6. Yeah, it's a long one. So hold on. Share. Try this. Copy. See if this works. See if it'll let me do it. There, try that. See, oh, there you go. Click on that one. So if you go watch that, and then we can talk on Thursday if we have to. Okay, awesome. Okay, so now, is it? Yeah, get the life insurance. It's not going to hurt you. Okay, go get it, Mark. Go get it. Bang that shit out. Get it off your plate. Okay, okay. Guys, if anyone else wants to, so Armana, maybe what you do is instead of sending the 66 one, which is what you're doing, can you maybe send Jen how you set it up, and maybe we can set up a Series 7 study group, because I think there are definitely people on here taking the 7. I have a couple of students I can send to that. So if somebody, like I think Jessica taking the 7, and I think Jen is, right? So maybe we can set up a study group for those people, right? Okay. So yeah, so there you go. So Jessica and Jen try to reach out to each other. If you guys don't want to put your email on here, go both of you shoot me an email and I'll connect you two tonight. And then you guys can talk. Or find each other on LinkedIn. That's probably the easiest way. Okay. Okay. Stefan, awesome. I love it. I'm so happy. I saw you on LinkedIn, and I think I put a congrats on there that you're starting at Fidelity. That's awesome. I'm so happy for you. When are you starting? In a couple of days? I love it. Okay. Okay. Sure, I can work on that. So I'm working on the 7 book. Okay. Yeah, that's awesome. So Sean, I am working on the 7 book. It won't be done probably take it. I do have a lot of videos on the 7. I mean, it takes a while. It's draining to do that book stuff. And then I got some other asshole trying to make fun of me for doing it, but whatever. Okay. Okay. So navigation. So again, for your day trading, yes, you can buy the same stock or switch it to do when a movie comes out. Yeah, but it doesn't always work. It's fine if doing it. So you're good. You're solid. Just if you're making money, stick with what you do, but make sure you have an exit strategy. I can't say that enough. But maybe put stop losses in that. So if a stock drops by more than 5%, you get out. The best traders have exit strategies and rules. They go, look, if it drops 5%, I'm out, and they just follow. So the best traders don't just go, I'm going to do this and make money. They think, what's the worst that can happen? They always think, what would be bad that could happen? And that's what you always have to think. You don't let it drive you, but you have to think, okay, when do I get out? At what point do I take my loss and just deal with it? Like I have stocks, like I have FANG stock, the FANG triple levered ETN. At some point I go, look, it keeps dropping, I'm out. It may bounce again, it's fine, but I'm out. I mean, I'm out and I'm not even looking at it again. I don't go back into shit. Okay. Mark, good luck. Boom. Yeah. Oh, that's awesome. Everyone. That's good. If anyone can give him a little advice on Fidelity interview. Okay. Oh, no. Kayla's playlist is now called, I know I took it away because people were like, what is it? Kayla's playlist is now If You Want to Pass the Series 7. It's kind of like if you do. Okay. Now, bid and ask. Okay. So I don't know how to do a question on it, but really, you remember. So the bid is, Sean, let me come back let me see if I can do a video on that so I can put stuff up, because I'm still trying to figure out how to do this third-party thing where I can share my screen on a live. I'm working on it. So, Sean, as long as you're not taking the Series 7 tomorrow, So they go, look, Sean, Jessica, and Jen, and maybe it's eventually Stefan, I call him Stefano because I had a friend named Stefano, could do a study group. I don't know how you do it, maybe on Zoom. Maybe you'll connect with me and then I can connect you all together. I think I did that with the other ones and do that. Okay. Okay, so how in depth? Oh, got it. Okay. So the study group's not going to help you that much. So, okay, so how do you feel, Jen? You should be fine. You're going to rock this thing. So how depth does the 7 go in the SMA? Not really. So yeah, Jen, I can't say that enough. You got to get some sleep. So so get off here. No. SMA is you have to be able to figure it out. Okay, if you can get SMA, how do I get SMA? It's on my videos, right? So SMA is your excess equity. SMA is always the amount of equity you have divided by Reg T. What's Reg T? Reg T is half the market value, half the current market value. So equity minus Reg T is your SMA. You have to know that, okay? Okay. Yeah, so look, Jen, you're going to nail this thing on Thursday. So then, good. So after you pass, you will pass the 7 on Thursday. I have a couple guys who are taking the 63 who are looking for other people. Okay. Now, so Jen, what are you going to do for the next 2 days? So tomorrow, no testing. Okay. I answered. Judy, I think you're not hearing me. I answered that. Okay. The admin can deny non-exempt transactions if they're not federally covered. It might have been a different question, but it's administrator can deny an exempt transaction if it's not because of federal, but no, exempt transactions are not federally covered. Exempt transactions are exemptions like unsolicited, selling to an institution. They don't have to allow them. They will. Again, that's way deeper than the exam. Okay. Yeah, and Mark, you like the 63-65 route, right? That you nailed it that way. I thought that worked for you. Okay. Perfect. I love it. Okay. Awesome. Thanks, Armana. That's awesome. Okay. Right. So that's the thing. I have a couple of students, like I said, who took the 66 and just couldn't get it for whatever. So we went the 63-65 route and they nailed it. Okay. Because I think what happens is then it becomes half a test, and even though the 65 is longer, it's more. I don't know how to explain how the 65 is different than the 66. It just seems to be a little more straightforward, a little bit more. Awesome. Okay. Okay. Again, SMA is not that big a deal on this exam. SMA is really the way I do my videos on if you need to pass the Series 7. I got to think of a better title for that. What kind of title can I put on that video, that playlist that says this is what you need to do to pass? I mean, that would have to say I don't know maybe you guys come up with something that will, maybe for Thursday, maybe you guys come up with some things on Thursday. So that if you want to pass the Series 7 playlist, sounds crappy. What would make people watch that playlist? What would make people go, oh, I'm going to watch these? Is it like the 6 videos you need to pass the exam? Something like that. We'll go there. Okay. So again, exempt transactions. Yeah, Mark's great. I talked to him a couple of times after, and he's a great guy, super full of energy and stuff like that. Okay. I didn't see Matt on here. Usually Matt's coming on. I'm trying to help Matt. I have Rachel, the girl Rachel on here. She is that used to be on here. She passed. She was great. She was super helpful with a lot of people. I think they're hiring. So if any of you guys who want the 7 and 66 or are close to taking it and looking for, a firm to work at, I think reach out to Rachel on here. And if I can hook you up with her, she's looking to hire people. And I think they're letting people work from remote, and they're super duper supportive. Okay. Awesome. I love it. I'm working. So 7 for dummies, that would work. That's interesting. I could do that. Okay. Let's see. Again, don't sweat the SMA. I think that works. We're at an hour. Not too bad. Okay. I agree. Boom. I'm heading out. Guys, I love it. Judy, thanks for the support. Good luck. You're going to nail it. And we got that. Okay, guys, if you like what I'm doing, please hit like, subscribe, and share. I'm going to head out of here. Wash your hands. Yeah, don't go to AXA. I agree. Don't go to AXA. I think they just rip you off. I think AXA will just take you and spit you out and they beat you up. Okay. Thank you guys. I love it. Thank you for joining in. Please, if you need the option stuff, you can go on my website and buy the videos that I did regular options and I did hedging. You can also just be a member and get that. Plus the membership has a couple of things where I do a video once a week. Sandy, I'm doing that. I'm doing the video this week. Okay. Yeah, exactly. The questions trick you. Just keep, again, you got to take your time. It's the wording sometimes that hurts people. Anyway, guys, everyone, thank you very much. I got to go try to eat dinner before it gets too late. See you all Thursday. And like I said, I'll see how Thursday goes. If a lot of people are on, I'll keep it up. If not, because the last Tuesday was not very, well, I think people thought I was still on vacation. If you like my stuff, go watch my little shorts videos. I think they're helpful. I think they're working. You get to see my grandson. Okay. You all have a good night. Wash your hands. And as Greg always says, may the force be with you. Adios.